Hello, Oracles. Today I'm going to be going over stock gap analysis for SOFI stock as well as the Russell 2000. We're going to be taking a look at all those gaps. Again, this is the third in the series. The first one we did Tesla and the S&P 500. Then we did Palantir and the Nasdaq. Now we're going to be doing SOFI and the Russell 2000. So again, for those of you guys who are new to this, when a stock price opens higher or lower than it closed the day before. So for instance, if a stock closes at $100 on one day and the next day it opens at $105, there is a gap between 100 and 105. Stock gaps typically fill 9 out of 10 times. Many a time they will fill the next day, they just kind of bounce back down, usually within that first half an hour of trading, and then they go back up or down from there accordingly. Now, there's other times where they do not fill and they can extend out. And as we saw with Tesla in the past, we have seen it go back as far as 2 years and fill gaps that were 2 years old. So, not to say that this has to happen, but again, historically, gaps fill 9 out of 10 times. So, it's important to just put that on your radar as something that's important to see is, what are the potentials of what's going on? And again, to me, when it comes to stock chart analysis, it's really more of a hey, I see what's going on in the market and the sentiment's going to move it one way or another. The fundamentals over the long term are really what's going to drive the stock and the company forward. But when you're looking at near term sentiment movements and you're saying, hey, we've got some bearish sentiment coming in, or we've got some bullish sentiment, you could take a look at some different things in the charts to let you know, well, what levels could we potentially move to up or down based on the sentiment that the market is feeling right now. Now, again, as I said, long term fundamentals for a company are really what's going to rule the day when it comes down to the bottom line of a long term investor. So, a lot of the stock chart analysis that we're going to be talking about today isn't really going to be pertinent for a long term investor unless you, as a long term investor, like to dollar cost average at better opportunities and you like to use the charts to give yourself an idea of, well, where could those opportunities potentially present themselves? And then we'll kind of wait for those moments because, again, being patient is what's going to get you the most bang for your buck when it comes to the market. You want to be patient. You don't want to buy when everybody else is buying. Dollar cost averaging historically is going to be the best way to garner long term wealth. But if you can kind of pay attention to things and say, hey, I'm actively managing this versus like a 401k, and I'm actively managing my portfolio and say, hey, I'm going to dollar cost average, but it kind of seems like it's a little too hot right now. Let me take a look at the charts and see, hey, ooh, there's some opportunities. There's some gaps that are down below us. Let me be patient. Again, gaps don't always fill and it could take a long time. Some things just keep on going up and up and up. So dollar cost averaging is still always going to be the best way to do this. But if you like to learn these things like that, or if you like to do some swing trading, these things could be very important information for you. All right, so jumping into SoFi first. So SoFi has been on a massive run. They closed on Friday at $16.02. They do have a tiny little gap that comes down here to 11.55. Below that, there's the gap down to 907 that was created on October 11th. A little gap down here at 786 that was created on October 4th. And then this tiny little gap, which I don't even know if we would consider it a gap at 751 from September 12th. And now prior to that, there really aren't all that many gaps because SoFi had been pulling down far and they kind of were suppressed for quite a while and they hadn't gone on a run. So they had this gap up here. So as you can see, massive gap here that went up to the 856 level. Gaps can be created above us. So that one there just got filled recently after being suppressed for pretty much this entire year. And again, this goes all the way back to May of 2023, where the lowest gap here is $5.48. Now, if you guys remember from both Palantir and Tesla stock, and when you're looking at the indices, May of 2023 happened to be a gap for pretty much everything. I don't know if this is one of those things where, hey, the entire market is going to be pulling back down to these kind of levels here, or if this was just that stepping stone to get us to the next level going up. But it's just coincidental that mid-May happened to be that time frame where a lot of the stocks and indices all started to gap up. So just something to pay attention to and think about as we're moving forward, especially if we're contemplating a potential recession for next year. Recession usually means we're going to have a massive pullback in the market. 2022 bear market, we saw a 40% drawdown. Could we see something similar to that or more? That could bring us down to some of those levels because don't forget, if the indices are going to be pulling down about 40% like the S&P 500, small cap stocks and things like SoFi and Palantir are going to be over exaggerated and can pull down even more than that. So just keep that on your radar as far as why it's going to be moving down. And if you're a long-term investor and you're not looking for a buying opportunity and you're not looking to sell at the top or anything like that, but you're also wondering why stock prices are pulling down the way they are, these tools can kind of give you an idea and a sense of understanding of, oh, okay, this is why the stock is pulling down. This is what the charts told us. It's not going to come as a surprise to me. It's just something that I'm going to keep on my radar and say, oh, yeah, okay, this is something we had talked about. This is something I expected. No big deal. Move past this and move on. Because historically, we always do move on. As long as you have a good, solid company, it is most likely going to grow even stronger coming out of a difficult economic time. So if we do come down to fill these gaps, just remember that if you're in good companies, chances are they're going to come out even stronger on the other side. And so again, there aren't all that many gaps for SoFi here, but again, looking at the recent ones, one, two, three, four gaps right here going back to the middle of September, I'm kind of looking at, all right, we kind of know that we're a bit frothy right now. We've got a PE ratio at around 91 with a forecast of a 131. That's pretty hot. Now, it is a growth stock, so that's something to be expected, especially during a bull market, which we are in. But we're also pushing much higher on the RSI here, pushing over 80 several times, and right now we're pushing up near that 70 mark as it is. So, not to say we can't push any higher from here, but if we do end up pushing up to finish off the year, this is one of those companies that I can anticipate potentially selling off in the early stages of January, when it seems like a lot of institutions are talking about doing the same thing around that time frame. And another thing to pay attention to as well, when you're looking at companies like this, Tesla, Palantir, who have all had massive runs since the end of the election, those things when you're looking at and say, hey, we come to the beginning of 2025 and a lot of institutions have made massive profits on these. They don't want to sell those off in December because they're looking to tax loss harvest. They don't want to take profits because then they have to pay taxes on those with a very small window of time. They would much rather take those profits in the first couple of weeks of January, and then that gives them the entire year, especially if we have the uncertainty and potential recession next year. They're going to be able to take those profits early because profits may be hard to come by come the end of 2025. And at that point, they can have those profits and then they can do their tax loss harvesting at the end of 2025 to offset those early profits that they made in 2025 in that January timeframe. So these are just the little things to pay attention to as far as timing goes when it comes to institutions and how they play off the taxes and all of that thing, because that is something that factors into them massively. And again, that's why we see that move the market one way or another when it comes to that tax loss harvesting time. So again, massive profits right now on these companies could continue to push up, maybe sideways, but whatever. They could push up into the end of this year and then early next year start to sell off as the companies take those profits early. And as we talked about what to expect this week in the market, when it comes to the inflation and Trump putting out tariffs, those tariffs could cause inflation to go up. That could spur on that recession because the Fed's going to be stuck in that middle ground where, hey, unemployment has been creeping up, so we should come down on rates, but inflation has also been creeping up, so we should be going up on rates as well to squash that. They're going to be kind of stuck in a little bit of a predicament there. That could lead the market to some uncertainty. And because of the uncertainty as to what could play out during Trump's first year in office, we could be having the market selling off, taking those profits, and just kind of sitting on the sidelines to wait and see what's actually going to play out. And so now when we're going to look at the Russell 2000, I'm looking at the IWM ETF that tracks the Russell 2000 itself. Small caps have been on a massive tear as well. There's been a lot of discussion about how small caps have been kind of beaten down for the last 5 years, partially due to the fact that we had COVID. And when COVID shuts down, the companies with the most money were the ones who were able to survive and get through it. Meanwhile, a lot of smaller companies struggled. They're the ones who needed to live on, debts and things like that, and they need that money to come in. But if they were forced to shut down, they couldn't operate as normal. That was a big problem. Then you push past that, and then all of a sudden, interest rates started skyrocketing. A lot of those small companies rely on all of those loans to come in, and they're paying higher interest on those loans. They can't afford to pay those loans back. They started folding. We saw more business closures this year than we've seen in the last 13 years. So it was very concerning this year, and obviously high interest rates weighed on that heavily. So now, as we're coming down on interest rates, that is a good environment for small caps. Then on top of that, Trump wins the election, and the market is also viewing that to bode well for the small caps as well. So as you can see here, the first gap, massive jump up here, the gap at 224, created the day after the election. Now, this gap here after the jump up did come down significantly, but it did not completely fill. It was a partial fill down here as we came down, but there's still this gap at 224 to 226. So this gap is still on the radar, and then we, of course, have pushed up from here. It is currently forming a bull flag pennant, which tells us that we could see another jump in the Russell 2000 to close out the year before we end up coming down, but this is what we're looking at right now. The gap before this, we go back to early September, and this is when we saw the first rate cuts. A little bit of a gap here from 212 to 213. And then you see these gaps here that got filled. This was back at the beginning of August, two massive drops down and sell-offs when it came to the Russell 2000. And of course, we came back up and filled those gaps from there. So of course, we did gap up before that. So this was like gap, 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 gap. And then we have since smoothed it out and filled out all those gaps that were created back in this July to August timeframe. And now, very similar to SoFi, you continue to push back, and there aren't a ton of gaps that were created in the Russell 2000 just because it was so beat down for so long. But you go back to November of last year, and there is a gap down here to 167, and another one here at the beginning of November going back down to 163.56. And then we'll pay attention and we'll take a look at the May timeframe as well to see if there was a gap. And the Russell 2000 at the beginning of June of 2023 did have a little gap that was created at 172, but that has since filled as it came down. So again, very similar to SoFi, where because it really hadn't had very strong runs over the last couple of years, not a ton of gaps, but more recently, and even within the last year, we do have some gaps that are on the radar to pay attention to. And again, I would be paying attention to potentially like probably a 163-ish as a low when it comes to the Russell 2000 if we end up getting a pullback. And now you have to remember too, when it comes to small caps, while yes, lowering interest rates is very good for the environment when it comes to the small caps because they can borrow money for cheaper, which will help them grow their businesses. If we get into a recession, they're the ones who are going to get hurt the most, very much like we saw during COVID and very much like we saw during the bear market of 2022 with interest rates going up. So even if interest rates get dropped down to zero, if we're in a recession, it could be a very difficult landscape for them to navigate, and that's usually what ends up selling off the most. So again, going into that early January timeframe with the uncertainty coming up with Trump taking office, we could see a lot of selling off coming from the Russell 2000 until we get that certainty. Now we could get to that March timeframe and we have a lot more clarity and certainty, and then we could go back up from there. And maybe we decide at that point, hey, recession's not really on the table anymore. We see things are going to go in a positive direction, and then they can push back up again from there. But until we get to that point and we have that uncertainty, we could have a bit of selling off going into that. Just something to pay attention to as we get into the beginning of January and the beginning of the new year. So those are the gaps for SoFi and the Russell 2000. Let me know in the comments below if there's any other companies you would like me to track when it comes to stock gap analysis. I'll take a look at those as well. If there's any other indices that are out there, I pretty much covered the big ones. I could cover the Dow as well, but the S&P 500 kind of covers that also. But maybe next week I'll cover one of my favorite dividend stocks and I'll throw the Dow in there as well to kind of cover all four of the major indices for you guys. And let me know your thoughts in the comments below. Do you think the market will end up pulling back down to fill a bunch of these gaps that go back to November or even May of 2023? Let me know your thoughts. Otherwise, thank you guys so much for watching. I appreciate all of your support. Have a great one.